Welcome to Views from the North, a Canadian rates and macro podcast. This week, I'm joined by Chris D'Onofrio, one of our Canadian dollar swap traders. This week's episode is titled Terminal. I'm Ben Reitzes, and you're listening to Views from the North. Each episode, I will be joined by members of BMO's FIC sales and trading team to bring you perspectives on the Canadian rates market and the macro economy. We strive to keep the show as interactive as possible by responding directly to questions submitted by our listeners and clients. We value your feedback, so please don't hesitate to reach out with any topics you'd like to hear about. I can be found on Bloomberg or via email at benjamin.reitzes@bmo.com. That's benjamin.reitzes@bmo.com. Your input is valued and greatly appreciated.
Thanks for having me back.
You're welcome. It's been a few months.
Yeah, but this is, I just want to say I'm glad the frequency of my appearances has picked up a little bit. Last time I think the gap was over a year, so.
You earned it.
Thanks, man.
You earned it. And full disclosure for everybody, I walked into the room and I've actually been trying to think for 2 days, what exactly am I going to talk about on this podcast? And I have yet to come up with anything. But luckily, Chris has wonderful ideas. And we've already had a long discussion before we even started. And I told him to stop talking, to not waste the good conversation. So we're going to go right into it. We'll talk about the bank and the Fed and pricing and swap spreads and all that good stuff. I think we probably why don't we start with what we've been talking about before we started here? Bank of Canada pricing, Fed pricing, where you think it's right, where you think it's wrong, how much further we can go. Why don't we start with the bank? We got them last week. They cut us as expected. Sounded more dovish. Do you think we're priced right? There's like 31-ish price for October at the moment, 31 basis points.
Yeah, that's about right. Like, I think I'm not opposed. Like, I don't think they go 50. I think they go 25. But I'm not opposed to some cheap option of a 50 being priced into that. That's I don't have any issues with that. Like, I think the whites. Well, maybe not all the whites. At least the early whites. So the next, call it 4 to 6 meetings are fine. I think we're tapering off a bit too quickly later, call it late whites, early reds.
So there should be more priced in there?
Yeah. It should be more, or at least some of the, maybe we're perhaps a bit too, it's probably just that there needs to be more, if I'm being honest. Because you and I were talking about this earlier, CAD US in late 2025 doesn't make much sense to me here. Like, I think the Bank of Canada, like, the curve just doesn't reconcile. Like, if indeed they're going to keep going at least 25 at every meeting, which I think everybody thinks they are right now, which is fine, then, why is that trend only continuing for the next few months here or for the next few meetings here, right? Like, we go out to something like U5, and U5 Canada US is in the high 20s, which doesn't, again, this is what we were saying earlier. This could be more of a comment on the US being too expensive, but if the US is right, which I don't think it is, but if the US is right, and if the Bank of Canada pricing for the next couple of meetings is right, then we should be more expensive than we are out there. I don't understand why that's not kind of the sweet spot. People are still kind of fixated on the next few meetings and not further out on the curve.
Well, so one of the reasons why they're probably fixated near term, and particularly for Canada in the October meeting, we got US CPI today. It was a little bit higher, so it kind of pushes the needle toward 25 from the Fed in September. But I don't think the September meeting matters that much for the bank. Like, if they were to go 50, yes, it makes the bank more likely to go 50 for sure. If they go 25, does it make the bank less likely to go 50? I don't think so. If you get the right combination of data being GDP being crap the way that it has been, honestly, and like the July flash was 0, let's say it comes in at 0. If the August flash is not very positive, and even if it's a plus 0.2, for example, you're still going to have a struggle for Q3, and you're still going to have growth so far below the bank's forecast that like there is a very low probability that the economy will be growing above potential. And the bank's whole forecast is predicated on growth moving above potential in the second half of the year and the output gap closing. And if it's going the wrong way, then you are way more offside than you thought. Clearly rates are way tighter than they need to be. do you still need to be well above neutral? Like if arguably you should already be in stimulative territory if it takes 6, 12, 18, 24 months for policy to really have its full impact. You might need to be in stimulative territory now, and we're at 4.25. Stimulative's probably sub 3.
Yeah.
So why wouldn't you go 50 in October? Again, this is all predicated on the data, 100%, because there's lots to go between now and then. Like CPI could be high, and then you get issues with upside risk to CPI and to inflation generally. And then that really does change the equation, even if growth is bad. If you have upside inflation risks, like that's their job. So they're not going to, they'd be willing to ignore the growth side of it until you get the all clear on inflation side. So there could be more is what I'm saying in the first few meetings in Canada.
Yeah, I just think that's even an argument like that. That's not mutually exclusive with what I'm saying.
It doesn't hurt the Canada.
Right?
Yes, it's not. It's
like,
not.
Okay, sure. If we are in that dire of a situation here and they cut 50, guys, like our reds should be 50 rich at least to the U.S., not 25 rich or 30 rich to the U.S.
I could not agree more. The problem is that I feel like we've been saying this for at least I've been watching that core to SOFR spread for I don't know, a long while. Yeah, many months I've stared at it, and
it's kind of come back and forth. But yeah, the last few weeks it's been painfully cheap.
It's moved, but it's come back here every time.
Yeah,
and if it's going to keep coming back here, then it's like, well, I don't know what's going to move it. It almost feels like there's heavy positioning there, and that's what's kept it from going, and that's probably why it's still here. At some point, the issue is it's so far away that like I don't. Getting the actual moves from the central banks maybe isn't enough to actually move those spreads. That might be the problem because you're looking at it in 2025, a long way down the road. And so that's why there might be a little more focus at the front meetings for now, especially with, I think there's 40 in the next 2 Fed meetings after September in each of the meetings. And if they're going to go 80 basis points in 2 meetings, like one of those is obviously a 50. Again, it's hard to argue that the bank may not be going the same.
So
the 50 as well.
Can we on that note, can we talk about the U.S. for a second?
Sure.
Yeah, so that's part of, like I said, it might be a comment not solely on Canada, probably at least in part on the fact that I think the U.S. is a bit too expensive here. I was saying earlier to you that I think some people, maybe a lot of people that are active in the U.S. are in assuming we should be in crisis pricing mode. Or maybe not crisis pricing, but not, hey, monetary policy is working, we're a bit too tight, we're going to start cutting and see where it takes us mode, which is kind of where I think it is in the U.S. I don't think it's like, oh my goodness, we did way too much and the data is quite dire the way it perhaps is in Canada. So the fact that, people are starting to obsess over the possibility of 50 right off the bat from the Fed seems a bit extreme to me. And that's why, you call the podcast Terminal. That's why one of the reasons why I think Terminal is probably a bit too rich, at least where it's implied from the low points of the Reds right now. But let's say the Greens is the proxy. I think.
What's that level?
It's a high 2s. It's
275-ish.
Yeah, 275, 280-ish, something like that. Yeah, which I think. Look, I'm not saying there's no world in which that happens, right? Like if you go back and look over the last bunch of cutting cycles, it's entirely possible. I'm just saying with the current information that we have about the U.S. economy, I think the probability distribution should be a little more symmetric about some sort of, for lack of a better term, soft landing, which I don't think is 275 at the moment.
Okay, so riddle me this. The Fed believes neutral is 2.875. So just under 3%, let's just say, to make life easy. If they think neutral is around there, shouldn't that be where they're going to end policy at the end of the day? And
it's kind of making the assumption
years?
That the Fed's right.
I agree.
About
I
stuff,
don't like making that assumption.
I don't know about that.
On that, I do agree. However, the U.S. economy is arguably much less rate sensitive than most others in the world, given the market structure and others. And it's proven kind of to be that way with how much higher rates had to go there than elsewhere. Shouldn't the same be true on the way down? That when they cut 25, what is that really? It's not going to do a whole lot. who cares? And so that's a decent argument for 50. And from their perspective, like if they think long run is just under 3, maybe neutral should be right there as well over the long term. Maybe it's slightly higher than that at the moment. Maybe it's like 350.
Yeah.
You're still a long way between here and there. So like, why wouldn't you?
Okay, I want to say 2 things here. One, I agree with you, but if it is indeed slightly above there, like I think too many people are like, oh yeah, the expectation is 3 or the expectation is 3.25, but there's this tail risk scenario that something blows up and we need to cut an extra 100, so we assign 5% probability to that, and therefore our pricing should be 275 instead of 3.
So
which I don't think is right.
So you're saying effectively, and actually, you know what? I don't mind this at all personally, but there's 2 tails.
That's exactly my point.
There's at least 2 tails.
That's exactly my point.
There's 2 tails, and the other one is like inflation comes back, which is one that I don't mind because I know I do think it will at some point. I just don't think it will right now, and that makes it much more difficult to get down.
Yes. Again, not a super likely scenario, but I think at this point, wow.
I think it's better than you'd think over like the 3 to 5 year horizon. Again, cyclical versus secular. On a cyclical basis, inflation is coming down, rates are coming down, everything's coming down. Don't fight it. That is my firm view. On a secular basis, when we're through this kind of downturn that we're seeing in Canada, China, Germany, broader Europe, the US, I can make a good argument that things have slowed there pretty meaningfully as well. When that is through, inflation, I do think probably picks back up, and like the trough on inflation again is going to be something kind of 2-ish. If that's the trough, what happens when it bounces back? You end up back in the 2.5 to 3.5 area, and things don't look quite as friendly.
Yeah.
And then you get that higher rate.
Yeah.
And then you're out in like 2027, 8, 9. It might not be 27. It might just be 29.
Yeah.
And rates need to be 4, not 2.875.
Yeah.
Sure.
Yeah.
Then I agree with you.
That's the kind of crux of my argument is that, like, guys, there's exactly to your point. There's 2 tails here.
But which one's more likely to come in the near term?
Oh, well, that's why you shouldn't sell the reds, right? You should sell at least the greens. Greens or blues, I think. In
that high tail, but in the meantime, that higher inflation tail, I think it's not going to even be a thought for most people till we're at the bottom of this cycle, and we're not there yet. And I think that's the problem. It's like, okay, well, yeah, I might think that 3 years from now, and like me 15 years ago with my economist hat on, when I did that all day, would have said like, yeah, that doesn't make any sense. We should have that priced in further out because fundamentally that's wrong. But the market doesn't work that way. Like they don't care about what's going to happen 4 years from now because whatever. In the meantime, It's like momentum is clearly one way right across the board. And like, why would I fade that? If anything, the market's thought is I'm going to be wrong because things are going to be worse than I thought.
Yeah.
Because that's the way it's been forever. And until they're proven wrong, which needs to happen, I don't think you get that reversal. So I would be uber cautious unless we rally more. If you get into you get to like the low 2s, then I think that can be a pretty clear sale because then Canada would be like sub 2.
Yeah.
Then I'm sure yours all day.
Well, then again, this goes back to it's like reds, greens, Canada, US, right? Like if you're long the Canadian reds but short the US greens or the US blues, you're probably okay, even if the world blows up in the meantime, and then we overcut, and then
probably okay.
That tail risk scenario of inflation returning comes.
Yeah, I don't know if it's my favorite.
Okay, well,
I hear you. I understand fundamentally. I just feel like and what happens if the Fed cuts 50 next week? Then you get your face ripped off.
Yeah, that's true.
And that's the risk, and I there's probably it's a non-trivial risk that the Fed goes 50 next week. Like I don't know how many, but it's several thought last meeting they should have cut. Maybe those same guys are like, okay, we got another mediocre employment report. Maybe the unemployment rate didn't go up again and went down a little bit. Great, but like household employment still barely or close to flat on a year-over-year basis, and that's not great. And payroll employment is clearly slowing. Momentum broadly appears to have slowed down. The second quarter was pretty good, but that doesn't look sustainable with the way employment growth is going. And so, like, rates are well above neutral.
Yeah.
Do they need to be here? And that's what I keep coming back. If I was a policymaker, that would be the question I'd continue to ask myself. And the only reason you'd want to stay here or anywhere close to here and only go 25s at a time is because you thought and you were worried that there's still this upside inflation risk lingering in the background. And you don't want to rush to that neutral point because if inflation picks back up, you're in deep trouble. So that's like the main reason to wait. Other than that, like, let her rip, man.
Well, okay, so this is the other thing. I said I wanted to say two things. This was the other thing I wanted to say, and it's more of a question to you, but, well, two things. Do you think cutting 50 off the bat sends the wrong message or induces, for lack of a better term, panic in certain parts of the market? One, does it? And two, do they care if it does? Because if pricing goes, off the rails, and now we're pricing in hundreds and hundreds of basis points of cuts over the next year and a half, does the Fed care?
What's the negative impact of that, though? If anything, that'll cause exuberance in a way that they don't necessarily want. And then they could pause afterwards, but you can message what you want to message. You can be like, yeah, we moved this time. Rates are going to fall further. There is no guarantee. And you can say it explicitly. Like, we'll look at every option, every meeting. And on the face of it, we're going to go down.
The market's not going to focus on that. The market's going to focus on, Powell said we're not in trouble, but he also cut 50. Like,
yeah, I mean, so I guess.
I don't know. I'm not saying that is the case.
There's two things.
I'm asking you if you think it's
and
the
I'm
case.
thinking about it as we work through it here. In my mind, there's two ways I look at it. One would be like, okay, is the market going to react? Like, does the Fed know something we don't? Oh no, things have gone terribly wrong. It's an emergency. Run! Yeah. And stocks and risk just get absolutely annihilated. That's possible. I don't think that's likely, though. I think it's the other way, where they're like, okay, they're trying to get ahead of this. Things are going to be okay.
Yeah.
And maybe the rate market prices in too much. I don't think the stock market goes crazy higher.
Stocks are rock solid,
they're already expensive. I don't think they go crazy higher. They do okay. And risk does pretty well, I'd guess, broadly on the back of that. Is it a great outcome for the market to price in even more easing? Probably not. But like, we're already most of the way there, aren't we?
I thought so.
Like, we have 100 plus basis points, or 100-ish basis points priced by the end of this year.
Yep.
And whatever, 2 weeks ago, there's 120-ish basis points. If we went back to 120, we go back to where we were? Was the world a terrible place? Had things melted down? Was there an emergency?
Yeah.
And they can say, you know what? We've decided that, like, we want to get to neutral in a relatively quick manner because we think rate policy is tight and there's no reason to be tight anymore. And when we get to where we believe neutral is, then we'll reevaluate. Is that bad policy?
Yeah.
Or is that the right policy? Is that like really the way you should do things? Because if you're waiting until the signs are clear that you shouldn't be at neutral anymore, then you've already waited too long.
Yeah. I don't know. I just feel like the market is really jumpy, and everybody's been waiting so long for this for the last couple of years that it's just going to be out of control.
Yeah, give it to them good and hard.
I don't know. I think the reaction will be more outsized than you think if they do cut 50. But
it'll be big. It'll be a massive day.
Yeah.
It'll be out of control, wild.
Yeah.
You won't be able to leave your seat. I, on the other hand, can leisurely get a coffee.
Yeah, exactly.
That's the luxury of my position.
Yeah, exactly. Okay, fair
It'll
enough.
be fun, but I don't think it has to be out of control. Like, we lived through a cycle with 50, 75, I can't even remember if they did 100 rate hikes, 100 basis point rate hikes.
Yeah.
And did the world end?
No, I'm not.
I'm asking. I'm saying it's a question. Like,
no, the world did not end.
3 weeks later, we were fine.
Yeah.
And there was a lot of vol, and and you know what? From our side of the business, that's great. Like, that helps the dealers generally. I mean, if you're able to manage it. And so, like, I don't mind it. I don't think it does make life challenging for sure, but it also makes life interesting, which is nice. Which I don't mind at all.
Sure.
Versus just like the predictable
Sure.
boom, 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 boom.
Yeah.
So I don't know. Well, I guess we'll see. I understand 100% where you're coming from, fully, completely, absolutely. But at the same time, I'd rather them just do what's right for a change instead of trying to placate markets or doing whatever the market is maybe not the best thing for the economy. I want them to do what's optimal. I think that'd be more fun.
Okay.
Would you like to tell us about swap spreads, Chris?
I can say a thing or two about swap spreads.
Okay. Why don't you tell us three things? No, I'm just kidding. As many as you like.
We're a bit. I think we've lost the plot a little bit over the last week or so.
How so?
I mean, there was a bit of a repo scare in the 2 years bond space. So that kind of richened everything up. And two's kind of led the way higher in the swap spread space, at least over the last week or so. And then we saw some offshore issuance. And anyways, now we're multiple 3 or 4 basis points wider than we were a week ago, I believe, which I think is wrong. I think
More positive.
yes, correct.
Okay.
I don't think the narrative has changed. Somebody made the argument to me today that, well, your rates are so low, something's got to give, and that might come from swap spreads because our lowest forward rate is 2.4-ish.
Yeah, it's 2.25, 2.30.
2.3, yeah, maybe. Yeah, 2.30, yeah. And, okay, something's got to give, so spreads should widen. I don't know if I buy into that argument, number one.
Why does something have to give? Like that's just
I don't
too
know.
rich?
I'm not even convinced that that's too
just
rich
too
for
rich?
Canada.
Is that? It's not too rich.
Yeah. Anyways, that doesn't make sense to me, but maybe I'm missing something. But truthfully, I think the thing is just nothing has changed in the narrative. I mean, we talked about this last time I was on the podcast. One, there are too many bonds, to put it bluntly. The cash buying, except for the last week, particularly in the front end, is not there. So it should be, I think, another slow grind lower over the next little while here. That plus the fact that, and again, this is kind of repeating ourselves from last time we talked about this, but the housing story hasn't changed, right? Like, I don't think we're in stimulative territory. People aren't rushing to buy houses here because they're getting great mortgage rates. Like, it's, a 5-year mortgage still is in the high, I believe in the high fours, maybe in the mid fours.
Mid-fours.
Yeah, like, I don't think that's a deal by any means. I don't think, we're going to see a pay party from the bank treasury community over the next 6 to 12 months. So I don't see the catalyst for them to stay here or go wider, really. Like, I think this is an opportunity to kind of sell the pop rather than to stop into being long. I don't know how you feel about that.
So I think bigger trend, I'm with you, like more bonds. I mean, we'll see what happens with our government after the NDP backed out of their deal with the Liberals.
Fair.
So we'll see on that front, and that is a wild card for sure. But as much as it makes it appear that an election might be imminent, we'll see.
Well, that's
I'll
like,
believe
we're
it when
talking
I
a
see
year
it.
away. Right?
It could be a month away. It could be a year away. It could
Yeah.
be a little bit more than that away. So I think that you kind of have to put that aside because there's no real, I don't think, effective way to predict what's going to happen on that front. In the meantime, more bonds. And if anything, going into next year, assuming status quo on the political side, there's probably more stimulus, not less.
Yeah.
And we're running a larger, not smaller deficit year to date.
Yeah, exactly.
And so again, more bonds, more bonds, more bonds. And as long as that's the theme, I don't know. I don't understand how spreads could go higher. Like, it doesn't make any sense. That's why we're here in the first place.
Yeah.
I don't see any other real catalyst. I mean, the flows on the swap side, the flows out of bank treasuries are a driver, but they are not the driver. They have added to the bigger theme. They're a secondary theme for me. The bigger theme is too many bonds.
Yeah.
And you can say the same in the U.S. as well.
And actually, on that
bonds.
note, from a global perspective, it's not even like our swap spreads are cheap, right? Like, it's not like, oh my
Exactly.
God, there's so much juice on these asset swaps now. It's like, no, they just look like more in line with the rest of the world.
Exactly. And so that's why they could actually keep going, and they're not even convinced they've necessarily based. When the day that issuance stops going up, then I'll believe that they've started to base. The other side of things is the housing. Where does housing take off? I grapple with this all the time. I still don't think it's not north of 4%. I don't believe.
You're talking in mortgage rate terms?
5-year mortgage rates. I still don't think it's north of 4%. I'm not even sure that it is 4%. I think you'd have to crack 4, so you need at least a 3 handle to make people feel better by just seeing the 3 in the first place. And even then, it might not be till 375 or 350 even. So then, and that's like 75 to 100 basis points from here is a long way down. And we might get there. So you said 6 to 12 months. I'd say 6 months more than 6 to 12 months because the next 6 months is, what is it? It's
that's what I was going to say. So maybe next season. Maybe
Yes.
next season it picks
Exactly.
up. But like, we got 6 months here.
That's
like,
a long way.
I don't want to buy spreads now. Like,
It's a long winter. Don't buy spreads through winter when housing is dead. And the other, there's like, I think, especially now, if you know the way the Canadian housing market works and the seasonality to it, like most of the activity is April, May, June, July in there, usually more like May, June, but
there's a bit of a lag, right? Because the activity picks up in maybe March and then.
Well, no, it's the big months for sales are
Yeah, for sales.
May, June.
For sales. Yeah.
And let's just say,
let's
say April to July, just to add a little extra. Things do ebb and flow a bit other than that, but those are the biggest months.
Yeah.
And right now, if you look at the market, you can see that there's gobs of supply, and it just continues to come. So there, houses that are priced right at the moment still go. There's still underlying demand. That hasn't changed. It's not going to change. But I do think people are aware that there is all this supply out there. And if you're a little bit patient, you can actually do a little better than where you are. And you don't have to come in at the offer side. You can bid a little bit lower and see if they hit you. And if they don't, you can just wait. And you can probably wait them out. And if you miss that house, there's probably 3 more that you can get that look pretty similar at probably at a similar price range. You don't need to buy the first thing that comes up. And it depends on where you are. Like a great example is like I looked for a cottage in, I don't even know, whatever, 6-7 years ago, and could not find one for the life of us. I mean, we went to look at a lot of them. They went in under a week, all of them, even though you have to drive 2.5 hours to go look at it. Somehow people bought them immediately. And we could not get one at the price that I was willing to pay, which, I mean, I'm pretty cheap, so that didn't help. And then now I look on MLS and I see all these cottages around the lakes that we looked at, and I'm like, these are great. I would love any one of these. We're no longer in that market, so we've gone away from that. But too bad. I mean, it just means that there's just that many more things available now than there were in the past. And I think that the cottage market reflects that. I think the Toronto single family market is a little bit more challenging because there aren't that many, like there aren't more houses coming online, but it's still looser, much looser than it was. Condos, there are just way too many. Like that is a potential problem. And the rest of the country, some shades of that. I think more, not as bad as the Toronto condo market, not as good as the Toronto single family market, but somewhere in between. Maybe more like the cottage market, where like there are more supply than there has been, and there's more choice. And you can be a little bit patient. You don't need to worry about it getting away from you. And the market's just not going to run away and be like, oh, you missed it, and now you're offside 20%. Sorry. Yeah. So I spreads from that perspective with mortgages probably not picking up this year for sure. Can continue to go. And on the provincial side, Ontario came with their 5-year deal, and that pushes spreads higher. But Ontario and Quebec are
that's a good point. Actually,
90-ish% funded now. And so, they could come with another deal, but then they're going to be 100% funded almost, or even close to it. And so you're going to get more limited offshore issuance. I don't think it's done, but I think the much more limited, smaller size probably. And so that's one less reason for spreads to push higher. Yeah. So on any pops, I'd still be a seller personally, but that's me.
Agreed.
Well, that's good that we agree
about something today.
Can't agree on terminal. We agree on U5 core SOFR. We agree on swap spreads, on wanting to sell spreads on pops. I think you need to wait for the pop to sell them. Yeah. Even if I think the trend might be lower, you just no way of knowing how much lower and when they'll base. They'll base at some point, but there's no way of knowing where that exactly is. So it is pretty challenging there. Should we get ourselves in trouble and talk about politics, or leave that to people that
listening.
Can't get
Go on.
Well, just for the benefit of people out there, I don't think everyone follows it that closely because, like, I don't know, I'm not even sure anyone cares until the election gets called. But Parliament comes back on the 16th of September. The Conservatives have said that they'll probably put forward a non-confidence motion, which they can do. And the Bloc Québécois have said that they're willing to work with the Liberals for the right price if it benefits Quebec effectively. So while there could be an election, it seems like the other parties, and the NDP probably the same. I mean, they'll, as much as they ended their agreement, if the Liberals give them enough, they'll probably be like, sure, we'll prop you up for another few months at least. Yeah. And so I mean, as much as it appears that the polls say that we should be having an election, given the low approval level of the current governing party, I'm not convinced that we're going to get there in the very near future. And then the next hurdle will be the fall economic statement in November, when we get an update on where things are, where the budget is, and however much more money, more or less money, but probably more, that they want to spend.
Yeah, and to be honest, on the election front at least, I'm not convinced from a market perspective, or from a market pricing perspective rather, it much matters. I think most people's assumption is that, in the next year, there's going to be a change in our government, whether it's a few months from now or a year from now.
if you look at the polls, it does say the Conservatives will win an election at the moment. I'm not sure everyone fully realizes, and our chief economist, Doug Porter, has highlighted this to me a few times. If the Conservatives do win, like, you keep in mind that we don't really have their full platform at the moment, but a couple of things they want to do. They want to get rid of the carbon tax, so that one's pretty straightforward. Temporary downward movement in inflation, one-time move, the price level goes down, blah, 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 at the end on that. But the other thing that we know they want to do is balance the budget. So how do you do that?
Allegedly.
That's what they say. So let's say they stick to their guns on that one. It just means less spending. Like they're not going to raise taxes. That's not consistent with their beliefs and their ideology. So it means less spending. Less spending means weaker growth. Weaker growth means lower rates. And so one more reason to think that rates might stay a little bit lower for just on again, it is cyclical again. But I mean, you can get easily into the low twos and stay there for a while if fiscal policy's going against the economy for a little while.
Yeah, I can see that.
Ooh, he likes that now. See, didn't think about that, did you?
No.
It's far enough out. To
be clear, I never said Canada wasn't in a bad situation. Like, Canadian economy is trash right now. let's call a spade, and probably will be for quite some time.
Sadly.
But yeah, I see that for sure as a argument for lower for longer this side of the border, at least.
Just for a while. I don't know how long that lasts. It might be a year or two. It depends on how revenue growth is. Like, if we get decent nominal GDP growth, you can grow your way out of it relatively quickly. Yeah. The current government has opted to spend most of that nominal GDP growth, and that's flows through into revenues. It's disappeared pretty quick. So that's where we are. We've talked for a long time. So what are your favorite trade ideas as we wrap things up?
I think we touched upon them a little bit. Yeah. Long Canada US in the late whites, early reds. Call it U5.
At what level? Because that is my struggle. I think mid-20s is like a no-brainer.
Even high 20s, I think. Okay. Yeah. I think, you buy that at anywhere north of 30. You sell that at anywhere in the mid-40s if it gets there. Even low 40s, I guess, which is pretty good. I think there is a trade in there, some sort of reds greens or reds blues. So I realize I keep just saying colors and not maturities, which, depending on who's listening to this, might not be useful. Like one year, 2 year, 1 year, 1 year, 3 year, 1 year. It's probably a better trade in the U.S. or 1 year, Canada versus 3 year, 1 year U.S. Something in there I think is pretty good. And then we touched on swap spreads. On pops, I would sell, particularly the front end of the spread curve, 2 year spreads. Those 2 year bonds, every time we roll a new 2 year bond, it's uber rich. So I think to the extent that you can sell those near zero or above -5, let's say, you probably should be, at least for the next, call it 4 to 6 months.
Okay. Awesome. Chris, thank you very much. Appreciate you coming on.
Thanks for having me.
And it'll only be a few months again next time, I promise.
Oh, we'll see.
Thanks for listening to Views from the North, a Canadian rates and macro podcast. I hope you'll join me again for another episode.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.